All right. Thank you, everyone. Appreciate you for joining us tonight. We're going to get started. Now the music's over me. All right, perfect. Thank you. All right, so thank you everyone for joining us tonight. As I mentioned, my name is Elise Rosemarin. I'm a Senior Vice President here at AKAM, and tonight we're going to discuss effective budgeting, ensuring your property is financially sound. That is obviously very, very important as we head into budget season. So joining me tonight, I have my esteemed colleagues, Avi Zanjirian and Meagan Mooney. Avi joins us. He is a partner at Czarnowski and Beer, and Meagan is our Vice President of Finance here at AKAM. So I'll just give you a little bit of their backgrounds and then we'll get started. So Avi has been a valued member of Czarnowski and Beer since 2007. He oversees the audit staff and is heavily involved in each client's audit process. Avi's skill set allows for enhancement of the firm's audit engagements, and his friendly nature, you are friendly, makes his rapport building with firm clientele effortless. In his spare time, he enjoys spending time with his family and contributing to various charitable organizations in his community. Thank you, Avi. Appreciate your time tonight. And Meagan Mooney is an incredible financial management professional with 30 years plus in experience, not to give away your age because you look very youthful. As AKAM's Vice President of Finance, she is responsible for overseeing financial operations for all of our clients. She ensures that documents are compliant and also supervises the creation and management of budgets, tax escrow accounts, financial accounts, and more. In her free time, Meagan enjoys spending time with her family. This seems to be popular, volunteering in the community, and horseback riding. Am I the only one that doesn't enjoy time with their family? No, I'm kidding. I love my family. All right, everyone, let's get started. Thank you so much. All right, so an overview of tonight's discussion. So we'll be discussing the goals of the annual budget, the budget process, best practices, and then we'll do a Q&A. As always, if this is your first time joining us, we do like to have this as a discussion. But of course, as things come through, please feel free to enter your questions into the Q&A box and we will get to them at the end. But if something comes up, again, and we don't discuss it, please feel free to reach out to any one of us and we'll be happy to get back to you this evening. All right, so let's get this fun with finance started. All right, so Avi, I guess, can you discuss the goals of the annual budget?
I sure can. Thank you again for having me here tonight.
Thank you.
I think everyone would agree that the goal of the annual budget is to make sure there's no maintenance increase or common charge increase going into the new year. Actually, probably the real goal would be no increase and maybe give some money back to all the owners. I know that's always something I hear. Well, why can't we do a refund? So in all the years I've seen, maybe that happened once. That has happened. So what are the goals? Goals are I like to break it down into maybe a couple of subtopics of that. And one goal is to make sure you understand what you're budgeting for. You're budgeting for a co-op or condo. A co-op and condo, I think a lot of people's opinion, mine, feel strongly about this, is a non-for-profit. The building's not there to make money. Obviously, if it has extra money, but we'd love for the building to put it to the side for reserves, for capital projects in the future, not to necessarily jump to give it back to the owners or give it back to the board members, God forbid. But we want to make sure we look at it that way. We want to balance our budget, make sure the expenses are covered by all the revenues, and make sure that we make informed decisions in terms of putting the budget together. We also want to think about the future. So usually, like you just said, it's busy seasons coming up, budget seasons coming up. That means the managing agents and boards are going to be busy putting together 2022 budgets. But do we want to stop there? Do we want to focus in 23, 24, 25? And I'm speaking necessarily of capital items that might be coming on the horizon. If you kind of take a tunnel vision on just the upcoming year, you might miss bigger picture items that are happening that are on the horizon coming up. You don't want to budget a deficit. I know this happens. I've seen this, and boards are scared to do an increase. The big pitch I get a lot, and it's hard for me as an auditor to obviously relate because I'm looking at it from a higher level. I'm from the outside. I'm independent. All the other buildings in the neighborhood don't having, our maintenance isn't in line, our common charges aren't in line. So therefore they'll make a decision to budget a deficit for the year. Okay, $5,000, $10,000. I'm not gonna I won't, I'm not going to slap you on the wrist, but I've seen buildings budget for 60, 70, $100,000 deficit, and they say they'll take it out of the reserve account. Now, is that really the appropriate, the way to go about it? You have a reserve fund that you're saving for a roof project, local law 11 facade work, an elevator modification, a roof deck, a new lobby, and now you're going to take 100,000 out of that bucket that a lot of buildings have worked probably really hard, really hard to save that money over the years, and you're just going to take it out and take it for operations. Don't do that to yourself. Don't let the information you're hearing from brokers and other people on the street make a decision that's going to do that. There are other ways that we can get around it, which we could talk about in a little bit. And the last thing I really like, or the last couple of things I like to talk about really is on the goal is remember that this document is going to sit with you for the next year. Right? So you're going to put together a budget. Hopefully you're going to do it timely. You're going to get it approved. It'll be a sitting document that purchasers are going to look at, attorneys are going to look at, banks of future purchasers or people that want to refinance are going to look at. This is the document that's going to be the face, along with the financial statements of your building for the next year. So if you are going to not put the right amount of effort into it, or produce or publish a document that shows a deficit, you're going to be answering those questions for the next year. And Meagan, I'm sure could tell you how many times she gets those questions. I get those questions sometimes as an auditor. Can you explain why the building budgeted a deficit, or how's it going to cover that deficit in the future? And those are questions and puts doubts in people's minds that want to buy into the building, and you want to put out the best product for your building that's going to be memorialized for the next year or so. So when you're looking at that from the perspective of looking at it from a non-for-profit perspective, that's one goal. The other goal is look at the future capital. What do we have on the horizon? Let's not do a deficit. Let's focus on making sure it's balanced, and remember it's a working document as well. I wanted just to touch about one thing in terms of goals that's more of an accounting terminology, and I'm not going to get into it, but I'm going to throw out the terminology of cash basis versus accrual basis. I know, so just the basic translation of that is cash basis means your financial reports are money comes in, money goes out. That's all that's reported in any given month, in any given year. So if you're not paying your bills and you're not collecting cash, those numbers aren't going to be showing up on your report. That's cash basis. Accrual basis is what should have happened. What money should I have received for maintenance or from laundry income or from my commercial units, and what expenses should I have paid? And the difference there with a budget is when you want to look at a budget for the full year, you want to take all the ideas of what should have happened, both on the revenue and expense side, and not look at necessarily what had happened on the cash basis, because that could construe your viewpoint and not give you the best picture in order to prepare the budget that's coming up for the year. So those are the 5 things we want to talk about. Again, just non-for-profit, prepare for view it as a non-for-profit, prepare for the future, no deficit. It's a working document for the next year, and then just understand it, whether or not you're preparing a budget on the cash basis or the accrual basis. So those are the goals.
Thanks, Avi. That was a great overview.
Thank you.
Made my job easy to set this up.
All right, we're doing.
Yeah, part of the budget is definitely what Avi was saying about setting the maintenance and everything he spoke about. It's a great time to also audit what you've done for the year and plan for the future. So auditing for the current year you're in, you want to make sure that you review your monthly financials, watch for variances every month, not just when you do the budget. But when you get to the budget, you want to make sure you capture everything that you had planned to do and see where you're off, so that you can plan for the future. Whether you have a situation, a lot of buildings last year had situations with commercial income not coming in with the pandemic. So predicting, are we going to not be able to collect those kind of things? Are we going to be able to put in a different commercial person there, into a spot to collect that kind of income. So it's really a great time to review what you've gone through during the current year, so that you can plan for the future. We want to look at trends, variances. What can we be doing better? If we see something starting to go awry, is there a way we can control expenses, review contracts, negotiate them, do something like that to make sure we control expenses? There are a couple of different components when we're looking at a budget. There's a lot of expenses that we will call fixed expenses and variable expenses, although the variable expenses aren't as variable as you might think, because something like exterminating might fall into the variable expense, and you really don't want to cut some of those expenses too short either. We want to make sure we look at, your payroll, your insurance, your corporate taxes, your mortgage. Those are all considered basically fixed costs. When we're preparing a budget, we want to start with some uniform assumptions. So what we'll do is go out to different experts and make sure that we get the best advice on how to predict for the future on these expenses, whether it be insurance, what we think is happening in the industry, that kind of thing. So we'll try and get those assumptions, before we even start the budgeting process.
So I wanted to, I guess I had something to, I know Meagan was talking about the benchmarking of expenses, looking at trends. We could just go back to the predictable expenses as well. We're talking about payroll, insurance costs, corporate taxes, potentially, I think, the insurance, like we said, looking at those items as they happen. Also, I know, we're talking about the budget process, but another big piece of the budget process is looking at your budget at every year as the year goes on. The working document I was talking about. Hey, hi Meagan.
I'm back.
You're back.
You were back.
All right, let me. I'll finish my point, and I'll bounce it back over to Meagan. That working document we were talking about at the beginning, about that being your document for the year. Meagan brought up a great point. You set this budget. It may be right, wrong, or not, and you want to look at it every month and say, how are we doing? Payroll, payroll should have been a predictable expense, right? It was $100,000 for the year, $120,000 for the year, should have been $10,000 a month. By March, April, if we're already blowing through half the budget, what's going on? Stop, raise the flag, call management company. Why, what did we do? That someone that, and there might be a reason for it, but you know what? It's better to know about it in March instead of knowing about it of March of the following year and say, oh, how come that all happened? Oh, how come we don't have any money? Oh, it's because this happened. And that's the the work that has to be done together. You're working now to prepare the forecast, but then you have to, while you're in the year, we have to make sure that when you get those reports every month, you're taking a few minutes just to scan through those variances. Anything that jumps out at you at your next board meeting, just say, hey, I noticed payroll's out of whack. Is this something I don't know about? And this way you could kind of right the ship before it goes south. So with that, I'm going to go back to benchmarking with Meagan.
Hi, sorry about that. I don't know where I cut off. So forgive me if I'm
It
repeating.
was the best part. It was the best.
Yeah. Well, repetition is good for a developing brain, said Jimmy Neutron. So utilities, energy, professional fees, real estate taxes. These are all the kinds of things we want to watch, benchmarking, where we've been historically, where are we compared to our neighbor, things like that. While I mentioned taxes, the taxes I think it's important because it's one of the biggest numbers in a co-op budget, that the taxes are based on an assessed value times the rate. And the assessed value is going to be the lower of either the assessed value or the transitional value. And the transitional value is based on a 5-year average of the last 5 assessed values. So if you can track what I just said, you can figure out the taxes. Otherwise, they're very easily accessible on the New York City website if you're in New York City. There's other items that we want to make sure we look at, the maintenance expenses. And again, a lot of things we think are not necessarily fixed items, but they're almost fixed because there's items you're not going to want to get rid of. You're not going to be able to get rid of your cleaning supplies, you're exterminating, your different contracts such as elevator or security. But these are items that are considered maintenance expenses. We do want to make sure that every budget, that when you're going through your budget process, you want to make sure to look at every single item as if it stands alone. So we wouldn't just want to see people put a flat 3% on all of their repairs and maintenance items and increase it, because that's not reality. You might have had something come up as a one-time item. You want to keep track of that as well. We actually like to make a lot of footnotes in our budget process, because you want to make sure that you're giving as much information as possible when you're presenting to your clients, to make sure everybody understands the process and what's included in those numbers. I think that was it on benchmarking and maintenance expenses. So I'm going to turn it back over to Avi.
Okay. I think those are all great points. And I just wanted to add on the expenses, two things that, that kind of rolling out of, COVID, it's something Meagan and I talk about a lot, is just the fact that when you're looking at trends, you have to be careful about using last year as your benchmark. And because there were a lot of things that happened or didn't happen. Supplies, for example, were up because a lot of buildings were buying PP&E. But repairs and maintenance might have been down because vendors, the repairmen couldn't get into the buildings because they weren't allowed to. Buildings had policies, the city had policies. So there's a lot of deferred. So you might have thought expenses were down, but you have $20,000-$30,000 of expenses that are now being paid in 2021 that should have been 2020. So like Meagan said, don't just take that number and multiply 3%. Say, oh, well, we had 50,000 of plumbing. Well, really 25 of that was from 2020 that we didn't get to till 21. Let's cut that forecast number down in half and give us a good projection for 22. The same thing with utilities of buildings that a lot of buildings. Meagan mentioned that they'll do a 3-year average on utilities. Well, what if the building was pretty much vacant? Everyone jumped ship during COVID. They went out to their vacation homes or found somewhere else to go to come out of New York City, and water and sewer was down, gas heat was down. You have to be careful that when taking that to consideration when you're budgeting into the new year. And then the last thing I wanted to add on was in terms of the real estate taxes, because New York City is on a fiscal year, which means that they budget from July to June. The right now the information that's available is July of 21 to June of 22, which not even that's not fully available. So when you're doing a budget for 22, you're really shooting into the dark and using assumptions for July of 22 till the end of 22. So that could work in both in the building's favor and also not in the building's favor. So when you're trying to do a budget, and a lot of buildings will do this, they'll be more conservative on the real estate taxes, because since that's the biggest number you have in your budget, if that number goes south and is off budget, that could be 1 or 2% could be a lot of money for certain buildings. So you want to make sure that you're looking at that number as those numbers come out during the year. So I've had buildings do this where they'll set a number, but let's say they won't do an increase because they don't need it, but they'll say, all right, well, we'll look in June of that year, in the middle of the year, and see how the new real estate tax year, projected forecasters are going to look. If they're in line with budget, then great. If they're not, they might consider doing an increase in June to make up for the real estate taxes they didn't budget for. And again, it doesn't happen all the time, but depending on the building and depending on whether or not you don't want to be so conservative with the real estate taxes, it's an approach that you might want to implement when it comes to your building, when you're looking at that number, which is such a big number.
Yeah, Avi, I just wanted to mention, I think you hit on a really good point, that being conservative is also possibly being realistic.
Right.
I think that's important when we're looking at the budgets and reviewing them and getting them together.
Yeah, rarely, I would say, I don't want to put numbers to it, but there's a lot of cases of being right on budget or being, below budget. It's when you have we were under budget by like $100,000 on real estate taxes is when you kind of say to yourself, oh, that was, that hurts. That hurts the most out of all the line items on the budget. So
Avi, I have a question.
Yeah.
Since commercial space, has obviously been hit during the time of COVID, how are you recommending people prepare their budgets in accordance to that, potential loss throughout the year? Because maybe it will get better, but maybe it will sustain. So how have you been, engaging your clients in that way?
This is a fantastic question. It was definitely a harder question to answer last year going into the 21 budget season, because everyone was just coming out of COVID and no one knew what was going on. And buildings, we had a lot of buildings that had done amended leases or given credits or abatements for a couple of months. By the time we were doing the audit in February, March, and April, those abatements were getting extended for more further along. I think the time has helped us here. Right now, we're almost a year and a half past when everything shut down, and businesses that might have said they'll recoup will know the truth now about whether or not they're going to be able to stay afloat and how much they can afford to pay. And obviously, I think a lot of boards have been doing, which is, I think, the smartest way of going about it is, again, it depends the type of corporation. You're dealing with a lease of a garage that maybe the garage company is backed by a public company, and they have the funds, and they're just trying to take the building for a ride. I completely agree with taking a hard stance and not giving them abatements. Because that, again, a lot of buildings that have commercial space, that's a lot of times 15 to 20% of their budget is commercial, and that's going to be a hit to the owners, to the residential owners. So that's really looking at it from two angles. Number one, do they need a break? Are they not paying because they really don't have business, or because they're just trying to test the waters? And I think the boards have to be strong if they're just trying to test the waters, and they see the foot traffic coming into the space, and looks like the business is running. I wouldn't be so quick to give them an abatement. But at the same time, also, if you have a business that is hurting for whatever reason, the business model doesn't, let's say barbershops that were thriving during, because everyone was in the city getting haircuts. Now people working from home, they're not getting the same foot traffic. You have to ask yourself a question. Do you ask him, how much can you pay? Let's say he was paying $10,000 a month. Can you afford to pay $5,000, so at least the space is occupied? Or do you kick him out and you say, listen, we you can't, you're not making your monthly payments, so therefore we're going to ask you to leave and go find somebody else. I think a lot of buildings are being conservative and saying, all right, let's see what we can get for now. But I think time, like I said, time has really helped all these buildings give everyone the opportunities that they originally gave them. So when we were doing the audits last year, they were giving everyone 6-month abatements. We'll give you 6 months. If you can make those payments, then we'll restart again. If those 6 months they're not able to make those payments, they're probably not going to be able to make it after that. So you have to be realistic and say, all right, time to leave. We'll find somebody else, or you deal with it. But when you deal with it and you do the budget, which I'm sure Megan's going to completely agree with me on this, don't budget for the full rent. They were paying $100,000 a month for rent. Now they're only able to pay 25. Don't prepare the 22 budget assuming they're going to be collecting $100,000 a month. You have to be realistic. And as much as it hurts, and I've had a ton of buildings that have been hurt. They've had to implement assessments. They've had to implement increases for 21 to recover the lost rents. To put a budget out with the $100,000 number when it's really 25 hurts. It's really, again, that's not the future thinking. That's going into the reserve account. You're pulling money out of reserves. You're gonna end up asking the owners for that money anyway. And you have to make the right decision with that, with the leases. So leases really, I think time has helped us to make boards to make those decisions, and you have a couple options there to be aggressive or not to be aggressive. So hope that helps.
That was very helpful. Thank you.
No problem. And then I'm looking at the slide. There is a interest income. The only reason this is here for one particular reason. I've seen this, and I can't say I completely agree with it, but let's say a building, I've had buildings that have large reserve accounts. Interest rates today on, reserves and money markets and CDs are really not fantastic. But if you have a healthy reserve, $2 million, and you're getting the minute, whatever, 1 or 2% probably is too high, but 1% on that money, that's money. And I see buildings budget for that as part of operations. I had a building that took out $6 million from refinancing, and they were generating like 40 or 50,000, 60,000 of interest income, and they were using that money to offset their maintenance increase. And you have to be fair to yourself. You just took all this money out for projects. Those projects are, to be used so you don't have to assess your owners. That interest income should go to the capital projects as well. And I think it's again, if you only have a couple $1,000s of interest income because your reserve accounts aren't high or escrow accounts, whatever it is, okay, fine. You want to throw it into the budget, by all means. But once you're talking about 20, 30, 40, 50,000, even I have buildings that have 100,000 interest income, to put that into your operating budget to offset expenses, I just don't think it's fair to your owners and to yourself, because once you spend that money, the interest income's gone, you're going to end up doing an increase. So you have to be careful with interest income and how that plays into your budget process. And then lastly, on the slide, maintenance and common charges, obviously that's a number that, going back to Meagan's slide about the expenses, that's a predictable revenue, right? How much maintenance is going to be. The one thing you really need to make sure you factor in are if you have owners that aren't paying, it's the same idea. The same idea with a commercial. If you budget what you expect to collect as opposed to what you're actually going to collect, there might be a significant difference. On a small building of 10, 15 units, one person's not paying, that's a significant hit to the building's operating budget. A building of 350 units, one person's not paying, okay, you may not need to factor that in. So it's something to consider. You have to be fair to yourself and realistic. I know that, this unit hasn't paid for 5 years. We've been in legal with them for 5 years. It's $10,000 or $15,000 a year of common charges, late fees. Don't budget the late fees and the violation income and all that into the budget. First of all, you're not, chances are you're probably not going to get the money once the judge rules on the case, unless it closes and they were able to collect on those receivables. But you have to be fair to yourself. That shouldn't be part of your budget, because then you're going to find yourself at the end of the year short that 25,000 anyway. And then you're going to ask yourself the question, how are we going to recoup that? And I think that's an important piece of this future looking budget process, is things that you might have deferred from last year's budget also need to be taken into account into this year's budget. So I know I gave the example of 21 going, expenses from 20 getting pushed into 22, not to be taken into account in the 21 not being taken into account to 22. You also have to think of, oh wow, I didn't pay for $50,000 of repairs in 21. I'm not budgeting them in the 22 budget because they're really 21 expenses, but you still didn't pay for them. So how are you going to cover those costs? And that sometimes is where I know assessment is like if you're a Harry Potter fan, it's like you don't say the word. It's like you're not allowed to say that word assessment. I have boards that forbid me to use that word on an annual meeting presentation. They use every other word, but you don't want to do an assessment. But sometimes to do that little catch up, right? You're behind, something happened, a one-time event happened. You do a special assessment for $50,000, $20,000, $100,000 just to get the building back to square one, and then you look at a clean slate going forward. Because otherwise, if you keep ignoring it, the 100,000 from last year is going to kick down to the next year, and then it's going to go to the next year, and it's going to go to the next year. And I understand that doesn't need an increase in maintenance. I agree. That's what I'm saying. I totally agree, but it needs to be corrected. And the budget process is the best time to do that.
Good advice. Thank you, Avi.
Pleasure.
Any other thoughts on this, Meagan, or should we move on to the next one?
No, I think he covered it pretty well.
You don't want to be taken to outer space while answering our question? I'm teasing. All right. So the next topic. Capital planning.
Capital planning. I really do believe it's a good idea to have a multi-year capital plan put together so that you can start to plan for how you're going to finance, how you're going to, pay for these projects. Useful lives, wish lists, upgrades, really keeping the value of your property up is important. And again, it's all about being realistic and planning. You might have someone say your roof warranty is up X year, but if you have someone look at it and it might have a longer life expectancy, then sure, you might have longer to plan for that future. Avi, I think you knew there were some different options on how to fund these kind of things, if you want to hit on that.
Sure can. I definitely can. The idea of a capital plan is important to have in your pocket, because what happens is I've seen I get questions from buildings. Hey, our mortgage is due. So just as a background, most co-op mortgages are set to a 10-year life. So it gives the buildings the opportunity every 10 years to refinance and look at, take out funds for projects or not, or just, refinance at a better rate. But usually it's a funding vehicle to refinance its mortgage. So a lot of buildings have been taking advantage of the low rates now to refinance. So while they're doing it, they don't have any projects, on the plate. But so they say, how much should we take out? So as if it's like a slush fund, the monopoly money, 1 million, 2 million, 3 million, 5 million. So the only way to answer that question is well, what do you have coming up in the next 10 years? Let's say you refinance today on August 17th, 2021, and this is going to mature in 2031. But and you can't refinance in the middle because there might be a prepayment penalty. For those of you that are not familiar, most commercial mortgages are set up in a way, co-ops as well, that if you prepay the mortgage before the term, there's a penalty, and could be a heavy penalty, hundreds of thousands of dollars. And so you don't want to put yourself in a position where you only take out, let's say, $1 million, and then you need $3 million 2 years later. So now you're paying $100,000 penalty and closing costs. So having the plan, the capital plan of what needs to be done, roof, we did the roof 20 years ago. So it's probably like Meagan said, yeah, we have a warranty for another 20 years, but it might go, the engineer might say it's going to go in 10 years. So having those figures available to you, so that this way you can make an informed decision and to take out how much you need, really is one of the important reasons to have a plan. On the flip side, I had a building go from a $2 million mortgage to a $9 million mortgage. At the annual meeting, the shareholders wisely asked, "Hello, board, why did you take out all that extra money?" "Oh, we have some projects coming up in the next." Do you have 6 million, or I think it was $6 million after closing costs? You have $6 million of proceeds. Of work. Well, they didn't have a good answer. You have secondhand embarrassment sitting there in the crowd listening to this happening, because you're like, well, if you didn't just treat the mortgage as a slush fund or monopoly money, you could have made an informed decision and taken out what you needed. It could have been only 5 million, 4 million. So that's the idea. So you have the plan gives you that opportunity to take out the funding that you need, the financing, to make an informed decision. So those are the ways of for cap. But then that's just, if you want me to talk about, we could talk about other ways to fund them. I don't want to talk about, I already said the word assessment once. I don't know if I'm allowed to say the word assessment again. But assessments are also an option. And assessments, when you're planning for them, are not as laborious as assessments when you're not planning for them. No board. Again, I always like to remind everybody, and the board members are shareholders and unit owners as well. They have to pay into these assessments just as much as the owners do. So when they make a decision to implement an assessment, it's not like they're getting they get accredited. They don't have to pay for it, and everyone else does. So obviously, when a board has to go out and collect $1.5 million or $2 million in 12 months, or even not even in 12 months right away because of a project, and they don't have the funds, that's hard. That's hard for owners, most buildings, I would say. But if you know, okay, listen, I don't want to take out a loan. We have a line of credit if we need it, but we know that in 5 years, we're going to redo the roof and we need $1 million for the roof. We're going to do an assessment for, a piece of it every year. Let's say we'll do the $500,000 in assessment and half a million in a line of credit. And this way you implement it over a short period of time, or a long period of time. And therefore it's not hard. It's not a hard hit to the owners. And this way, having the capital plan allows you to do that because you know what's coming up.
Great advice. So now we'll discuss some best practices. And I'm sure a lot of boards are curious, to hear, Avi, what your take is, and Meagan, what we do here. Because budgeting, as you mentioned before, is very, very important. And there are certain buzzwords like assessments, which definitely, being a former broker, I can understand why that is a very cautiously used word. But as you mentioned before, there is reasons for it. So can you guys discuss, what you recognize as best practices, especially because we're getting ahead of budget season. It hasn't officially begun, which I know you're very excited for, but, so people can prepare in advance, as I'm sure we want our clients to.
Yeah, sure. I think prepping up, making sure that, back to Avi's point about planning for capital projects, use the resources you have. We have an in-house architect that can help plan for these things, how long things might last. Really going to the resources you have at your disposal to pre-plan this stuff is really key. I would try and get your team together and get a timeline for your budget. You want to make sure you sort of, I like to back into, well, when do we need to notify owners if there's going to be a change in something? I use the calendar year as an example. If you need to notify your owners in the beginning of December, that means you need to vote on something at the very latest your November meeting. So that means you should have a draft in your hand by the end of October so that you can push forward with that. So backing into the timeline and making sure you have your team ready to go with those documents is important. I think being realistic with the timeline and making sure you ask your team. Financial analyst, you can get you can always have your CPAs review. We also have in-house CPAs that review our budgets before they go out, but having your individual property CPAs review is another idea as well. I know Avi and I do a couple of buildings together that we, I might run a budget by him and say, how does this look? So using what resources you have is important.
Right. And then Avi, what do you think?
Yeah, that timetable always scares you because you're, as Meagan was saying, well, if you want to get it in December, you got to approve by November, which means you have to look at it in October, which is only 2 months away. So it's always, but it's the truth because there's so many times you'll see is that management will make sure to get the budget out timely. And if you need the increase, the important piece to understand is if you need the increase for 2022, if you don't implement the increase on January 1, 2022, that means that you're losing out on that revenue that you're not billing, and therefore you're going to get behind very quickly. And because of the time that's needed from the management to update the bills and to get them out and get the letter out to the owners, looking at the budgets when they come out, it's important not to sit on it. And I know a lot of times what will happen is the reason I think boards a lot of times sit on the budgets is because they don't like what they see. Not that the product's wrong, it's that, wait, you're saying I need a 9% increase in maintenance? Can't be, so I'll take a look at this in detail. And obviously boards are volunteers. They have other jobs that pay them to do what they do best. And therefore it's hard for them to to spend the focus there. But I think, if that's, if that's the case, that get somebody else involved. I've had board members say, hey, look, management's suggesting 9%. That's crazy. I can't believe it. Can you take a look at it? I don't have the time. I'm sure your CPA will, I shouldn't say I'm sure, I take that back, but they'll want to spend the time. They'll take a cursory look at it and say, hey, listen, focus on repairs, focus on real estate taxes. You listen, your payroll doesn't look right. Maybe something happened that they're not accounting for, and things like that. So those are important things to make sure that you got, the boards handle, because again, like I said, if you don't do the increase till April or May, that's 3 to 4 to 5 months of that year that you're losing out on. And then to go and retro that back to January puts a burden on the owners, that you're going and saying, we're doing a 5% increase effective January in April. It's not, sometimes not fair to them to do that. And another best practice we talked about at the beginning, but it's worth reviewing this again, is that once you do approve your budget, make sure that management has your budget in the monthly report, and that this way, when you're looking at it every month, it's the updated budget. There's so many buildings that we get the monthly reports that the budget column is not filled in. So it's hard to analyze the data, because what are you comparing? You're looking, okay, I'm looking at numbers, but I don't know if they're right, wrong, or different. And if you don't, or they'll have last year's budget in there. It wasn't updated for the new budget. So updating your budget, approving your budget and getting it in the monthly report gives you a better tool as a board member to review the financial statement. So I think those two things are really, I think, best practices, going into budget season, along with everything else we talked about.
Great, thank you.
Yeah. The one thing I wanted to add was, and also making sure that whoever's uploading that budget is seasonally weighting the information. So you don't just put in, your heating expenses and divide by 12. You want to make sure you put them in the months where the expenses incur.
Right.
And you have variances, you are able to flag them or track them.
Right. Or like real estate taxes, you want to divide that by 4 because you make 4 quarterly payments, unless you're obviously budgeting the escrow amount, which some buildings do. But yeah, in January, you'll be way over budget. By April, it'll reset itself, and then so on and so forth. It's a great point, Megan.
All right. Thank you, guys. So we're going to now turn it over to our Q&A session. And I know that we already have some questions that came in. So of course, please feel free to ask any questions that come to your mind. And again, if we are not able to answer them this evening and you think of them later, please feel free to email any of us and we'll get back to you as soon as we can. All right, so this is a new board member and they're asking if you can explain the roles in the budgeting process. How should the treasurer, the board, and the management company be involved? So who wants to take that?
I can start off, and if I miss anything, really your management company has the information. They should be bringing you, at the very least, a draft and reviewing it with you. You want to be involved in the process as a board member for sure, but the management company should be bringing you the draft so that you can be the informed decision maker.
Great. Any other thoughts on that, Abby?
Yeah, in terms of the board members, I would imagine that usually the person holding the position as the treasurer has a financial background. Obviously, there are situations where someone becomes a treasurer because there is no one else to take the position, and they're learning themselves. So if you're not comfortable as a treasurer, like I said, utilize your professionals. First, go to the management company. Hey, can you walk me through this? If they are not, or if you don't want them to do it, go to your CPA. Can we have a 15-minute call? Just what should I be focusing on? Done that many times with new treasurers who, they know what they need to look at, but they're not. They get scared because it's just a lot of numbers. It's an industry they're not familiar with. They balance their own budgets at home, which again, I think very similar to a co-op or condo, but again, there are more numbers, more categories, and they want to make sure they're doing their fiduciary responsibility. So it definitely should have a first pass with the treasurer, let her make any comments and revisions, and then you pass it along to the rest of the board. And that, I think the treasurer says, hey, I noticed X, Y, and Z. Management made a couple of updates. I think this is a good budget. To everyone take a look at it. And then if there's any additional revisions from there, make those revisions and then get it approved. That's why I do have buildings that have finance committees that will look at it together. They maybe the treasurer has two other members that are not two other owners that are not members of the board, but have a financial background that want to help during budget season. And hey, all right, let's look at it together, and we'll present to the board. But that's, those are the different ways you could split it. But I like Meagan to the management company has all the data. They're preparing the budget. You might want to ask them your questions first because they have everything there. And then once you get all those questions knocked out, then go to the board.
Great, thank you. All right, can you guys tell me what a restricted fund is?
Oh, sure. That's a good question. It's a little technical now. A restricted fund. So restricted fund, I also is kind of synonymous with restricted cash. So how I usually define it simply is going back to my example about the assessment, right? Let's say, you're doing the roof. It's going to cost $1 million. You decide to do a 5-year assessment to collect half of it, $500,000, and the rest you're going to finance. Now you're collecting this $500,000 assessment monthly. That money that's being collected is restricted, right? The board restricted those funds for that purpose, for the roof. Obviously there's tax benefits that are available to, which I don't want to get into detail. If there's other questions, I want to make sure we get to them. But that money every month should get swept into a separate bank account and should be labeled on the management report and along on the financial statements as restricted cash. And then when the time comes that project is to be started, the money comes from that account. And that's what is restricted. It's restricted for use on something specific. It doesn't have to be capital. It could also be, let's say the bank, when you refinance, said you need to keep $50,000 with an account with us, and you can't use that. So that would also be restricted cash. It's your cash, but it's restricted for the bank. So that's what, on a high level, what restricted cash is. Restricted funds are funds used for a specific purpose. Great,
thank you. Can you tell me what a patronage refund is?
A patronage refund. I'm assuming, Meagan, correct me if I'm wrong, but a patronage refund would be that near NCB. Yep. I'm assuming that's where this question is coming from. Yep. New York Community National Cooperative Bank, which does a lot of co-op mortgages. What they'll do as part of the closing costs, part of the closing process is they will have the building purchase some stock. They have Class A stock and Class B stock. The Class A stock is real cash that sits on the building's balance sheet, and NCB will pay out around now, November, August or September every year, pay out a patronage dividend towards the building. And they actually been, the last couple of years they've been a nice amount, depending on how much stock you have, obviously. But again, it's just something that NCB does for its clients as part of the closing to reduce closing costs. But again, you are still paying for that. It's cash you receive. And the only thing I'll add on to that is that if you had an NCB mortgage and now you don't, and you're with another bank investors or whatever, make sure that they give you that money back. They'll still pay you the dividends. So it actually might still be a good investment if you want to keep it there. But it is your cash. And a lot of times they don't automatically just refund it to you. You need to ask for it. So if you have 40, 50,000 in NCB stock, ask for it back if you want to invest it somewhere else.
Got it. Thank you. Can you tell me about condo best practices and how to prepare an annual budget given operating expenses? So should you, put 10% aside as an example, by an amount for common charges? Is there a certain best practice that you like to use regarding that?
Sure. I mean, in terms of what we've talked about this whole session, co-ops, condos, I think a lot of it applies. The real estate tax portion obviously doesn't. Condos, unless they own the resident manager unit, which is usually a small number, don't pay real estate taxes. But the best practices with condos is you mentioned that 10%. It's almost probably about 10 years ago at this point. Fannie Mae put out guidance that condos would any condos that they're backing financing for, they would like to see a budget item for 10% of common charges. We like this. I think, Megan, we like that guidance because it's forced savings for the building to put into reserve accounts. And I've seen a lot of buildings benefit from this, being able to put 10% in. So if you have a $3 million budget, that's a significant amount of money, both in the positive and the negative. It's a lot of money to have to put away, but at the same time, it's also a lot of money to put away. And if you're doing that every year, you're building your reserves every year. There's obviously, again, tax advantages to that, which I'm not going to get into. But it's a good forced savings. I imagine, the question might be, is it required? Is it, what if we can't afford to do it? What happens if the expenses are coming really, I have to do a 10% increase in order to keep that 10% level of common charges. You have to ask yourself, and you have to ask your building, well, is that important to us? I'm not going to come out and say that you should get rid of it. Maybe you want to budget for the 10%, the full 10%, but only allocate 5% because it's been a hard year. COVID's been a hard year. You had a commercial space not paying, so therefore the revenues are down. Fannie Mae would understand, but I've had buildings that have gone to do, owners have gone to do financing on their personal units, and they've been rejected or because they don't put that 10% line item in there. And I've seen this. I don't see it a lot. I don't always hear about it. It might happen, but they don't tell me. But it is a best, that's a best practice, both from the Fannie Mae perspective, but just from a fiscal perspective, to put away 10% of your budget every year, you're not going to end up, you might not have to assess for projects when they come up because you're really saving a lot of money every year, or setting aside, I should say.
Great, thank you. Speaking of, what is the difference between reserve funds and capital and operating funds, and how are they each to be used? This is not a Jeopardy question. Kidding.
The difference between reserve funds and capital and operating funds. So yeah. Operating funds is like your checkbook. You think of it as your own personal finances. You have a checkbook, and you pay your bills from that checkbook. I mean, I know people don't use checks anymore these days, but you have a checking account. That's where you get your direct deposit to, and then you have, I guess you could call a capital fund being kind of your restricted cash, where you have money set aside specifically for capital projects, whether or not you've detailed and understand what those projects are, or they're coming. That's what your capital fund will be. Reserve fund, if you're so lucky to have this extra cash flying around, to also have a reserve fund, by definition, in my mind, is a rainy day fund. It's not set aside for capital projects. It's not operating money, but you have whatever, I don't know. You had a good year for whatever reason. You had something come through. You're building that gets money from filming, film income. You had one of these TV shows, film, and you got $100,000 from film income. You didn't know what to do with it. You didn't want to restrict it to capital. You didn't want to keep it in the operating, so you put it into a reserve account. So that would be, my definition of the reserve account. There's another fund that exists, which is a very important fund if we're talking about cash, which is your escrow fund, especially for co-ops that have real estate taxes. If you're self-escrowing because your bank doesn't want you to for real estate taxes, you make sure that you're setting aside money for real estate taxes every month, because those payments are made quarterly, and those are usually a large payment that needs to be made. So if you're not escrowing for real estate taxes, make sure you find out why not. I'm sure you probably are. So just make sure you understand that. So I hope that answers that operating versus capital versus reserve.
Thank you. All right, so we're gonna have one last question, and of course, please feel free to email us once again at the end of this, and we will get back to you as soon as we can. And thank you both for having such a great conversation and getting us prepared accordingly. All right, so what is the best way to reduce the payroll cost if the actual is 80% of the budget? You're smiling, you like this one, Avi?
I'll start off with that.
Ah, there you go.
Please, please. I'd love to know.
Saving.
Yeah. Well, I guess there's a, I think monitoring overtime is important. You want to make sure that overtime is in control and that it is, if somebody's doing overtime, it's either pre-approved, or if it's an emergency, that it's controlled and reported on. So I think overtime is one of the issues. And really watching your staffing. Are you thinking of reducing staff? Because that's a whole nother process, especially if you're in a union building.
Sure. Yeah. I've only seen it successfully done.
I've seen
it's a hard process.
I've seen it a
But
couple times.
Yeah, there are, and I've had a bill. I had a bill and I imagine whoever's asking that question, if 80% of it's probably a condominium. Most condominiums, the biggest expense, especially if it's a union building, 80% is really high. I've never seen that much, but I would say anywhere between 50 to 60% of a condo's budget, if it's union, will be payroll. And looking at, like Meagan said, looking at, do you need all the staff? Obviously, the fight with the union on that is hard. But if you have a good not a good reason, but a good argument, and it's valid, I've seen it done. And it can be a significant. You're talking about you're just getting rid of one employee, as much as it's, I'm sure, there's some ethical things that people have to deal with, but it's could be $100,000 between benefits, payroll taxes, and the actual payroll to get rid of one employee. And I would look into those. But yeah, the overtime is making sure that the overtime is watched over, is monitored, as we call it in our auditing world, is very important.
Great, thank you. And my favorite is one last tip as we finish tonight. Can you give us one each tip as we prepare for budget season, your favorite go-to tip that you like to tell your clients? Avi.
No, I was going to say ladies
Putting
first.
you on the spot. I'm going to let you. He is my friend. I'm kidding.
Yeah.
No, you are too. Avi, please. I guess you can just answer
Yes.
one great one. That'd be great.
So my one tip with all this is if when you're bored, I think doing this as a team is a great approach. Not everyone might feel they have the skill set to do it. They get scared of numbers. Like I said before, call your professional, call your CPA, call your analyst at your management company, and say, hey, just walk me through this. Don't feel like don't shoulder the burden by yourself. It's a big undertaking. It obviously affects everyone's personal finances in your building. Don't make those decisions on your own, but at the same time, don't also ignore it. It's a very important process. Obviously, it's become a little more difficult because of COVID and when things before might have just been very kind of straightforward. We know where things are going. The trends are where they are. Things have changed. And evaluate it and see places where you could save. I'll just give one story, and then I'll just to emphasize that I had a building that they just couldn't understand what was going on, and we went through the repair, supplies, and maintenance category together, and they looked at a couple of categories. I think it was like lobby flowers and exterminating and something else, and they said, do we need to spend? They were spending like $1,000 a month or something like this on fresh lobby flowers, or weekly. I forgot, it was something like that. And they said, well, why? Let's try using those, fake plastic flowers. We'll buy a nice arrangement and put it out and see. And they were able to do that with a couple of categories and spend the time. And they saved $20,000-$30,000 out of their RS&M budget. And, because they spent the time, they used their professionals, they called us in. I mean, I didn't give them that idea, but they called us in. They called, the property manager. We sat down and we went through it, and I think that's the takeaway from all this is just use your professionals around you to get through this process, and you'll have a great year.
Thank you, Avi. That was a good tip. See, even on the spot. And what about you, Meagan?
Yeah, I think asking questions of all of your professionals and being realistic. It's your tool to set the charges for the next year. So it's your budget. And it's, you know, within your rights to ask questions and make suggestions and get responses. So be your own advocate.
Yeah. Well, thank you both. Really appreciate your time tonight, and I really appreciate all your time tonight. So Avi and Meagan, all of our information is listed here below. So please, of course, email us anytime. We will get back to you, and have a very, it's a beautiful night. So go and enjoy it. But anyway, thank you for joining us. Have a good one, guys. Bye-bye. Thank you.
Thanks for listening.